A truncated week, so it's the last trading day for the week, and one is actually sort of thanking our stars because the kind of relentless sell-off that the markets have been seeing, thank God it's a truncated one, and thank God today is the last trading day.
You know, when weeks are volatile, I always say TGIF, thank God it's Friday. But I said, thank God there is no Friday.
Thank God there is no Friday. But yeah, it's getting a little scary, and the kind of pounding that our markets have been seeing, we've been already establishing the kind of disconnect that you have with the Trump rally that's playing out in the West and what's happening with our markets. Of course, Asia also was weak, extremely weak yesterday. Even markets like Japan, which are seeing some inflows, they also weren't spared. But we've managed to hit that 4-month low. Yesterday alone, we were down a good 350 points in the Nifty. And by the way, the Nifty has already fallen a good 8% from its all-time highs. So from there, intraday itself, we've seen a good 350 point knockoff. We did breach below the 200 DMA as well on the index on an intraday basis yesterday. So a very mild bit of recovery towards the dying minutes of trade, but negligible as such. Pharma, metal, banks, they all managed to hit 2 months low. Realty, energy, autos, these indexes were at a 5-month low. And the broader indexes, that's the mid and the small cap indexes as well, they managed to hit a 3-month low for itself. And of course, I'm not even talking about individual names here, because the damage on some individual portfolios, if you're staying put in the market, has been quite vast.
There is no way you can say that markets mein acha kuch ho raha. I mean, the price action has been poor, it has been terrible, and it has been horrible, so to speak, at least in some pockets. So what we will do is that next couple of days on ET Now, we are committed to really find out why markets have fallen, where are they headed, and what should be your investment approach. Now, the why is easy to understand, the why. But in the why, apart from FI selling and what is happening at a global level, now for the first time, you are seeing what could be called as pain at HNI and lack of commitment at retail. So that explains why. Where are we headed? Very important. It's like a, winter fog. It's not going to be permanent. And there are seasons where the winter fog is high, but there are times when there is going to be sunshine. I think that is the way I would describe this correction, which is that I think it is cyclical, and all bull markets, they correct. If you're a long-term investor in this bull market, if you spend time rather than panic, I think you would be handsomely rewarded. But the turning point, I think, will come when you would see at a global level either the dollar index changing or the yields, they start coming down. Already brokerages have started talking about that the Trump rally and the strength in the dollar will not last. So my sense is that sooner than later, I think we could be at that turn where US markets will start topping out, dollar index will start topping out, and yields will start coming down. And I think the more important point, Aisha, when we are discussing where and what, I think the where is a function of what has dominated the world in the last 6 months or 8 months. A lot of election talk. India, US, Japan, Europe. That kept everybody guessing. Second is a lot of earnings talk, which I think is the reality. Things are slowing down, and that is getting captured in the price. And third is IPO talk or IPO action. These three factors will not be at play in December, January, right? Because earnings, will slow down, election is over, and IPOs will not be there. So the pressure in the market, if it was coming from these three pockets, that should start finishing. My sense is, sooner than later, the dollar index will peak out. The Trump comeback rally will start fading out, and the market will start normalizing. But by the time that happens, you'll have to deal with the pain.
Yeah, and I think that is the next question, right? As to what should investors do? I mean, it's not like bull markets have not had severe corrections. History has told us that even in peak bull markets, you've had a good 15 to 20% corrections, and this is at an index level. I'm not talking about individual stocks at all. What is it that investors should be doing right now? I mean, should they be juggling their portfolios, booking profits? Is that the time now to capital protect? Is that the sense that one should be, going in and approaching the markets with?
See, Asha, you're absolutely right. And that in best of the bull market also, we've seen 15 to 20% correction. Even in this bull market, memory sometimes is very short. We don't remember. The market fell when Ukraine-Russia happened. Yeah. The market actually fell very hard. inflation came back. US Fed started increasing interest rates. So it's not for the first time the Nifty has gone below the 200 DMA, which is what everybody is talking about. So guys, let's take it easy. It is happening. It has happened in the past. It will continue to happen. So it is not like the end of the bull market and there is only going to be, there is no light at the end of the tunnel. I think we will come out. What may happen and what may not happen is, unlike a rising tide phenomenon where markets and everybody had lost sense of valuations and they were riding on momentum, that momentum has got challenged and it will remain challenged for some more time. Which is that in last 1 year, 80% of the stocks they went higher. But I think now the market will get divided. 20% of the market is looking attractive. 50% of the market soon will settle down 5-10% here or there, and then 20% of the market will remain down. The question is, where is opportunity in this market, where you could see time-wise correction, and where you could see the market still needs to correct a bit, or earnings have to catch up. My sense is, Aisha, pharma is looking attractive. My sense is select auto is looking attractive. My sense is energy transition is looking attractive. That's the part where you will start seeing activity coming back. My sense is that IT, PSU, defense, railways, anything which has got to do with this entire government capex theme, I think will start settling down as government activity will pick up. And my sense is that you should avoid consumers. You should avoid those expensive cyclical stocks. You should avoid those overhyped 2-digit stocks, especially SME stocks. I don't think they will come back. So it's important to understand that there was a rising tide phenomenon which took everything higher. Now 20% of the market is good. 50% of the market may not go anywhere. 20-30% of the market still needs to correct. That's how I see things.
Yeah, so seems like the poison is not quite out of the system just yet, but just look.
If you like this video, then like, share and subscribe to ET Now.